The recent developments between the United States and China caused bond yields to soar. But my next guest says, despite that initial movement, when it comes to the bond market, nothing has been priced in at this point, including concerns about tariffs or a possible recession. And she's here to tell us why. Alex Gorewicz is Portfolio Manager, Active Fixed Income at TD Asset Management. It is lovely to see you.
Thanks, Kim.
It's
Likewise.
been a long time.
Yes, it has.
What do you mean nothing has been priced in?
Okay. So let's say very broadly, generically, there are two key macroeconomic drivers for bond yields.
Mm-hmm.
There's growth and there's inflation. So on the growth side, because of trade policy, right, from the start of the year, so pre-inauguration, we know that recession probabilities have risen for investors. They're never zero and they're never 100%.
Right.
There's always a spectrum, but we know they're higher than where they were at the start of this year. When we look at the level of interest rates, however, they're roughly unchanged. And the reason for that is because on the flip side, there are inflation concerns in the bond market. If inflation concerns rise, usually bond yields rise. But I mentioned bond yields are unchanged. And one of the reasons why on the inflation front is because shorter-term inflation expectations are higher. So investors are saying, okay, tariffs could lead to price pressures in the near term. We're not seeing that yet, but that could happen. But longer term, because recession risks are higher, inflation expectations are actually lower. Go figure, right? Year to date, long-term inflation expectations in the bond market are actually lower. So you have these very competing forces. You don't really have recession priced in. You don't really have inflation priced in. The bond market's just in limbo.
Interesting. So it's almost, and I'm going to paraphrase, and you can tell me if I'm wrong, but it's almost like it's netting out to zero, right? It's just because of what you're saying is like, what you said. I'm not going to rephrase it. I mean, you said it very eloquently yourself. What does this mean then? You know, what is the market pricing in then for rates? Like if it's pricing in potential for inflation in the short term, but not in the long term, what is it pricing in for the rate reaction there too?
It means that if we do have growth weakness come through, the bond market's expectation of what the Fed will do, there's a lot of room for more rate cuts to be priced in. If that happens, that's when you can expect bond yields to come down. In the absence of that, right now, the bond market's taking sort of the path of least resistance and saying, maybe the Fed will cut 2 more times, 3 more times over the next year, but that's about it. So I think the caution of all the different scenarios that can play out are just manifesting in a more neutral outcome for the Fed, which ultimately drives where bond yields will go. But there's a lot of room for that to change in either direction if we get a lot of inflation or if we get recession.
Right. So many moving parts.
Right.
I mean, you know, this is the thing, of course, when I think about people in your line of work. I mean, there's never been so much moving at the same time as there has been, I'm sure, in the past few years. What can you tell me about what the bond market is pricing in from a recession standpoint, the likelihood of a recession? Because you're saying right now it is saying that it's seeing a growth slowdown. Is it seeing a recession, or what can you impart from that?
I wouldn't say it's base case recession.
Okay.
So the probability of a recession is higher, but I'd say if we were closer to 0% at the start of the year, now we're maybe a third to 2/5. So somewhere between 30 to 40%. Certainly not the most probable outcome, but I think you were starting to see a little bit of that in the corporate bond market, where spreads started to widen quite quickly, especially for lower credit quality debt. That has come back very quickly, not only with the announcement of the 90-day pause for the rest of the world, but now more recently with the US-China developments. And as corporate bond spreads retighten, as things settle in the bond market, not just for government bonds, but for corporate bonds as well, those recession probabilities are now starting to grind tighter, so grind closer to zero the way that they were at the start of the year.
Part of the interesting thing I know about what's getting priced in the bond market right now is less about inflation and growth, but more about, I'll say, the internal politics of what is happening in terms of who's the Fed chair and what's going to happen there. Because I know you speak to my producer about that, and that's something that's, not even so much who's in the chair, but does the position lose its independence?
Oh, yes. So the way that I mentioned that inflation with respect to trade policy is not really a concern for the longer term for the bond market. it's very clear that bond investors are paying very close attention to how the interaction between the U.S. administration and the Fed is developing. Now, in the last couple of weeks, as all this uncertainty around trade policy and the market reaction that has come with it, especially the market volatility that has come with it, you've seen rhetoric from President Trump, ratchet up when it comes to the decisions of the Fed, but Chairman Powell in particular. But then there was backing off, right? When investors got a little bit jittery about that pressure, it seemed like the White House backed off, like Donald Trump backed off. We know, however, that Powell's term ends in roughly a year from now. There is concern from bond investors that the next chair will be one that has, let's say, a closer relationship with the White House. So that independence that the bond market is depending on to, we'll call it anchor long-term inflation expectations, that will come into question over the next 12 months.
You talked a bit about maybe the concerns about the independence of the position of the Fed chair. And I want to talk a bit about how is that playing out internationally in terms of maybe faith in using the U.S. bond market, buying U.S. bonds. We've seen some sell-off and people looking for alternatives. Is this a moment in time, or do you think it's going to continue?
I think there's certainly potential for it to continue longer term. What we saw, we'll call it during the height of the uncertainty post-Liberation Day, was a very abnormal combination of the US dollar selling off, risk assets selling off, and bond yields, treasury yields rising. That really is an indication, not just of a loss of confidence per se, but outflows. And it could be for a number of reasons. I think a lot of people want to, or wanted to, explain that move as an indication that, oh, the US is becoming an emerging market, or, oh, confidence is being lost in US policymaking. But the way that I like to put it is that we can't forget about the fact that interest rates are higher in markets that for a long time saw zero or negative interest rates, and I'm particularly talking about Europe and Japan. These were markets that for years saw their domestic investor base, and they have huge savings collectively, look to the rest of the world, and in the US in particular, to get higher yields. But as yields in these markets have risen, right, in the post-pandemic era, there is now an alternative to the US. So if you're not really sure how policy will shake out in the US, it's not that you're retaliating by pulling your money.
There's other options.
There are other options now. So part of it, I think, is a long-term confidence game because, yes, we're starting to see some positive developments that, this strategy that the US is using is actually going to lead to negotiated outcomes. But at the same time, longer term, people are looking to diversify away from the U.S. And I do think that that will play out over years and decades to come.
Well, the interesting thing, I think, too, and I'm sure this is all part of it, is that, if you have countries like Europe and, name them, who are now being forced, let's say, to spend more on national security, therefore have to raise money to sell bonds, and to your point, now there's just more out there.
Correct.
And so there's more optionality for people at the same time, too. So you don't see this as a short-term trend. This is just something that's going to continue. That's
right. And to your point, one of the things that we've seen very clearly, and this is happening here at home as well, from the uncertainty around not just U.S. trade policy, but just U.S. policy in general, and in particular wanting the rest of the world to step up with their investments, with their spending, with their consumption, is that it will result in more bond supply in these other markets that historically didn't have enough demand or didn't have enough supply, rather, of bonds to meet the demand, because whether it's Canada, whether it's Europe, whether it's Japan, very strong savers relative to the US. So yes, absolutely, as these markets start issuing more debt, it will meet more and more of that domestic demand for investments. You mentioned Canada, and I do want to talk about them. We're still waiting in terms of what the agreement will be, and just was speaking to Derek Burlton earlier, talking about how, he thinks 2026 might be the earliest we're actually going to see some sort of agreement of something that comes between Canada. But he was also saying he's seeing softness in the hard data already. Yep. You believe Canada may already be in a recession? For sure in a manufacturing recession. And what worries me about that, especially, and I do concur with this idea that a lot of our negotiation about a longer term trade relationship with the US will come next year. A lot of my concern about how this nascent manufacturing recession in Canada, and in particular in certain provinces, is going to just have broader effect of spilling over into service sector of local economies that are most impacted by the job losses that we've seen to date and that are very likely to continue. Now, on the flip side, we will have support from all levels of government. We're still waiting to see the Ontario budget, for example. We have a new government now that the election is out of the way at the federal level. But at the same time, we don't have the budget there. We don't know to what extent there will be very targeted support for these manufacturing sectors that are impacted, particularly auto, but as well as steel and aluminum. So I think it's still too early to know how much support will we get for how long until we have a better understanding of that long-term steady state relationship with the US. And in the meantime, a lot of jobs in Canada are very dependent on that.
What do you expect the Bank of Canada to do, and just in terms of their reaction to this impending recession?
So I could tell you the bond market, for example, has 2 rate cuts priced into the end of the year, which doesn't sound like a lot given what I've just mentioned about job losses that are accruing, that we might be, even if it's a technical recession, we might already be in one. So to me, I would take the over on that, as in it's possible Bank of Canada could ease a lot more. There are some who say, well, Bank of Canada is going to be worried about decoupling too much from the Fed, right? We talked about the fact that it's possible the Fed will stay on hold until it understands how these recession versus inflation dynamics, that's right. But really, Bank of Canada has to pay attention to dynamics, here at home. Inflation is very much anchored and under control. And I would say, even with this notion of anchored inflation expectations from the bond market perspective, if they apply in the US, they definitely apply here at home. And we certainly have much weaker sentiment outlook for both the economy and for inflation that I think warrants additional easing from Bank of Canada.
I have like 10 seconds. I was going to ask you the US dollar. Where do you see it being in the short term?
Just in the short term, I think these positive developments around trade negotiations or trade deals could lead to a little bit of consolidation around current levels. We've seen a bit of a bounce back in the last couple of trade sessions. Longer term, though, that sort of investor outflow theme will likely lead to a lower US dollar.